Hello there traders, my name is Elizaveta Belugina. I'm the head of analytical department at FBS, and I'm very happy to join you today at this live Forex market analysis webinar. So let's begin our discussion. There are many interesting events which have happened since the last webinar, and let's discuss these events. So first of all, let's look at the US dollar index chart. We can see that American currency managed to recover from the 55-week moving average, which is located in the area of 98.50. And the US dollar is testing levels in the area of 99.50, trying to close the bearish gap which was formed several weeks earlier. All in all, the main bullish driver of the US dollar is the expectations of the Federal Reserve's June rate hike. Actually, after the US labor market data for April came out, the data was a bit mixed. The unemployment rate has dramatically declined, but the reading of average earnings wasn't really impressive, and some of the previous readings for March were reversed to the downside. Still, even those readings that we had seemed to be good enough for the US Federal Reserve, as comments from the Fed speakers were rather positive, they were rather hawkish. All in all, those members of the Federal Reserve who spoke after the release of the US non-farm payrolls for April were rather positive, and they viewed the developments at the labor market as okay, and that gave the market the reason to expect a rate hike next month. All in all, the Fed speakers warned that it seems that the current levels of the US interest rates are too low, and the time is approaching when the Federal Reserve should raise rates. Such speeches, such talk from the US Central Bank members have fueled the market's expectations. Currently, we can judge that from 90 to 100% of June rate hike is already priced in. So, of course, any disappointment, any comments from the FOMC which will be not in line with this idea will discourage the picture for the US dollar. And also we will be watching the US data releases, like the block of statistics, which is due on Friday with inflation and retail sales. If we look at the weekly technical chart, it seems that the support of the 50-week moving average is rather strong, despite the fact that the US dollar went to test levels below the support line, which connected the lows of 2016 and 2017. Despite this dip, we are now back above this line, and this is a positive sign. Rebound from the moving average is also kind of strong signal. The bear has the US dollar index has bounced from the level. So of course now the picture turns towards levels in the area of 100 and 101 for the US dollar index. And also we have here the daily chart to see that this movement in the US currency was rather strong to the upside, rather rapid, and the index is now at the middle of the descending wedge pattern. So it has some scope for further increase to the upside. Supports will be located once again near 98.50 and a bit lower in 98 areas. These levels should be pretty strong. If we look at other markets which have importance for the currency market, I'd like to point your attention to the chart of oil, in particular to the Brent futures chart. And here we can see that this week there was a sharp rebound in oil prices. There were several reasons for that. One of these reasons, the main one probably, is that the US fuel inventories have declined. And another reason is that Saudi Arabia reduced supplies of crude oil to Asia more than expected. So this reduced supply, reduced inventories, made oil return to levels above $50 a barrel and to reverse last week's losses. All in all, such factor as higher oil certainly increases expectations, inflation expectations in developed economies like the euro area, like Britain, and this is a factor which may lead to more hawkish commands from the central banks. Actually, today we have the meeting of the Bank of England, which is approaching us. And which will take place in 50 minutes. We'll find out the results. It's actually a super Thursday for the Bank of England, as we have not only the results of the meeting, the interest rate decision and other monetary policy decisions, but also the Bank of England will release its inflation report, and the minutes of today's meeting, so we'll find out how the members of the British Central Bank have voted today. Let's review the picture looking at the weekly chart of the British pound. Firstly, here we can see that at this moment the pound remains close to 7-month highs and in the vicinity of an important psychological level of 1.30. Last week, the British pound took a leap to the downside, but the 50-week moving average, which is located at 1.2818, provided good support, and after all, the British currency managed to bounce from this level and return towards 1.30. All in all, the fact that the British pound is at these 7-month highs is connected to the recent, more or less recent news that the UK Prime Minister Theresa May decided to hold snap election on June 8th. And well, we can see that political agenda is really impressive in Europe. Firstly, we got French election. Now it's time to talk about the UK snap election. And all in all, it is expected that the ruling Conservative Party will manage to strengthen its positions in Britain and thus be more resourceful and more able to hold British economy together and to manage the process of Brexit. This gave British pound some stimulus to get to these levels we are currently seeing. Still, it's clear that 1.30 is not an easy obstacle to break for the bulls, and if we look further, we can see that there is a bearish Ishimoku cloud. I'll now try to make it a bit brighter for you to see. Here it is. The lower border of the weekly Ishimoku cloud is currently located around 1.3090. When the Ishimoku cloud is so wide and heavy, it's certainly not easy for the currency pair to break. So during the times of the general downtrend, when the Ishimoku cloud is above the current prices, it acts as a resistance level. And if we look earlier at the weekly chart at what happened in the year of 2015, we can see that the same bearish Ishimoku cloud prevented the British pound from appreciation. And now this downtrend continues, and once again the cloud is acting as resistance. The moving averages on the weekly chart are also having bearish bias, although the first obstacle the pair has managed to overcome. This is the 50-day moving average, about 50-week moving average, about which we have been speaking today. This level is now located at 1.2785, and I'll mark this level as support for the British currency, because once this level played the role of resistance, and now it plays the role of support. This is how things change in the currency market. In addition, stochastics indicator is in the overbought area, so it also means that the bullish momentum is kind of declining here in GBP USD, and the weekly lines of the Ishimoku indicator, the red line and the blue line, are more or less horizontal. So another sign that momentum to the upside is not really strong. So moving to the daily chart here, we see that on the daily chart, the moving averages with shorter term periods, like the 50-day moving average, is turning to the upside and getting ready to cross the 200-day moving average to the upside. This is a bullish sign. Yet the lines are significantly below the current prices. So the general tendency, the general idea is that the prices may return to the lower levels, just support at 1.2785, before they continue their attempts to get higher. At this point, I think it is wise to add some fundamental picture to our technical observations, and it is important to point out that the Bank of England is not expected to change its monetary policy today. The regulator is expected to maintain its rather loose monetary policy and to keep the benchmark interest rate at the record low minimum. The markets will be interested in the fact of how the members of the bank's monetary policy committee have voted. Last time in March, one of the MPC members, Christine Forbes, voted for a rate hike, and this was a positive surprise for the British pound at that time. She is expected to stick to her view that a rate hike is necessary, but her vote won't be that important any longer. What markets will be concerned about is whether other members of the regulator have joined Forbes in her desire to raise interest rates. There are some candidates who may do so. This is not regarded as a very likely option. So despite the fact that the markets are currently preparing to some kind of disappointment from the Bank of England, and this is what we hear from the majority of the analysts. If there is such unexpected event as 2 members of the Bank of England's Monetary Policy Committee vote for a rate hike this time, then certainly we'll see an attempt of the British pound to break 1.30 levels, and we'll see the prices trading higher than this level. Why the majority of analysts are so negative about the Bank of England, and why the analysts expect dovish comments? Well, despite the fact that there were some bright spots for the British economy, I mean strong PMI data, strong services, manufacturing and construction PMIs, which have been released recently. Data today showed that manufacturing data, industrial production data of the United Kingdom were rather weak, and we see that the overall performance of the UK economy remains mixed. So, judging this rather controversial economic data and the fact that still there is Brexit to make, and the fact that there will be election in June, the Bank of England is expected to refrain from any hawkish comments and refrain from saying that high inflation creates necessity for the regulator to raise interest rates. Inflation indeed in the UK is above 2%, and that may be a reason for the Bank of England to start normalizing its monetary policy. But once again, there are many factors which kind of prevent the central bank from being too hawkish. So if the Bank of England doesn't sound hawkish, if the Governor Carney isn't concerned with high inflation, and if only one member of MPC votes for a rate hike, then we'll see the British pound correct to the downside, and will target levels at 1.2785. The next support will be located around 1.2625, 1.26. On the other hand, if there are 2 votes for a rate hike, and if Carney expresses concerns with high inflation, then the pair will challenge 1.30 mark and may approach 1.31. But at this point, there will be resistance we will be seeing. Let's also have a look at Fibonacci levels from the Brexit decline to the lowest points of this year, and we are approaching 38.2% Fibonacci, and this level is located near 1.3140. So I would like to keep this in mind as resistance as well. So let's also have a look at the weekly pivot indicator. Here it is, just to renew its levels. And I remind you that the blue line here is the pivot line. So as long as the British pound is trading below this line, the weekly bias is to the downside. Above this line, the weekly bias is to the upside. Here we can see that the pair is consolidating around this pivot line located at 1.2930, and we see supports and resistance levels provided by this indicator. So you may use these levels as reference levels for your trading positions as well. Usually when the pair is breaking the first resistance or first support, you can use the other two resistance and support levels as your targets. This is how these levels work. And now let's check other currency pairs, because here the price action is also rather interesting. Let's have a look at euro dollar, and let's have a look at the weekly chart of this currency. Here we have an interesting picture. It kind of resembles what we see in British pound actually. And if the week is closed below levels around 109, then we'll get a bearish engulfing pattern on the weekly chart of the euro dollar, and we'll likely see the pair close this bullish gap and aim for levels around 107. Let's put the Ishimoku indicator here as well for our technical references. And here on the weekly chart, we can see that here as well, the Ishimoku cloud acted as a resistance. It switched from bullish to bearish. Now it is bearish. The cloud has narrowed, but the current cloud, which is near the current prices, still acts as resistance. The pair also is now below the weekly moving averages. One is located at 109.90, and the second one is located at 108.87. So keep attention, keep looking at these levels, because they really are important. On the daily chart, we still see that the pair has this upside bias. It is trading in the rising channel, but it reversed down from the upper border of this channel and is now moving lower. Here we also have important moving averages we need to be aware of, and here have a look at the 200-day moving average located around 108.25. This 200-day moving average earlier several times acted as good support and resistance. Here, for example, in March it was resistance. Resistance in November. It provided support several times during the months of August and September. And earlier this line was also respected by the market. So pay attention to this level this time as well. And below this line, we'll watch levels around 107.40 and levels around 107 and 106.80. So decline below 108.25 will mean that the picture has become significantly bearish, and this will be a rather safe bet to target 107.40 and 107 marks. All in all, we can see that the current technical picture kind of opens the way for further correction of the pair to the downside. Yet the fundamental picture for the single currency is not that bad, really. Here I'd like to point out that there are reasons to expect that the euro will be able to find support on the dips, support on its declines. Higher oil prices once again increase expectations that the central banks and the European Central Bank in particular will taper its monetary stimulus and move to the more normal monetary policy. So as now we have a significant reduction in political risks in the euro area, we know that French presidential elections were won by Emmanuel Macron, a centrist who is a pro-European policymaker and who wants to deepen the European integration. This is certainly positive for the euro and will increase the market's confidence in the European market and in the European currency as well. So this is one of the positive development. The market has priced in such outcome, and this was one of the reasons why the euro dollar descended from levels above 1.10, where it found itself at the beginning of this week. So this is why euro corrected to the downside, but the market will likely return to the idea that the picture in the euro area has significantly improved. The euro area's economic data are also rather positive. They show that the European economy is resilient and is recovering. So all these factors will likely make the market to expect European Central Bank's monetary policy tapering, and this is a good source of fundamental support for the euro. For now, we have another factor which makes the pair decline. This is the factor from the American side of things, and it is the expectations of the Federal Reserve's June rate hike. But still, much of this is already included in the current price of the pair, in the recent decline of the pair. So I would encourage you to be attentive, to follow the developments, and to be conservative if in your targets on selling euro dollar. Levels around 107.40 would be very comfortable if we get a dip below 108.25, but I wouldn't risk lower levels here, and as we may get a rebound from the lower border of this upside channel. Next, I'd like to speak about dollar yen. Let's switch to the weekly chart, and I'm just going to get rid of some levels which are not welcome here. And here we can see that there was a break to the upside. The pair is at least testing levels, upside levels on the weekly chart. We can see that after the pair's correction in the form of the flag, the pair is trying to break above resistance and get higher. If the pair managed to overcome the level of 115, then this flag formation will surely encourage it to test levels around 118.50. Now we still are watching for the week close. It is interesting that the pair will manage to close this week. All in all, the picture looks positive. the pair is now already above 100 week moving average located at 113.25. This is support level for the pair. Let us mark it on the chart. And further support levels are located at the top of the weekly Shimoku cloud around 111.29 and maybe a bit higher, 111.50. We can say that. MACD indicator is rather positive on the weekly chart, and so is the stochastics. So weekly chart gives us a positive view of dollar-yen currency pair, although we need some confirmation that the break has really taken place. On the daily chart, we can see that we can be more precise in drawing these lines of the pairs channel. And here we see that there was a clear exit and a clear break above the daily moving average. 100-day moving average is located at 115 mark. And the pair may test levels near 115. This is the important psychological resistance level, and the level we focus on the upside. However, pay attention to the fact that here on the daily chart, stochastics is overbought, and the moving averages on the daily chart are horizontal. So here the pair lacks momentum, and it will likely revisit the former resistance and now support in the area of 113.25, 113 before it makes another attempt for 115 level. We can see that yesterday's candle was rather small in comparison with the previous candle. So here I see signs of some setback before we try to test higher levels. All in all, the policy of the Bank of Japan seems rather loose. The Bank of Japan's Governor Kuroda acknowledged last week that there were some improvements in Japanese economy, but still the Bank of Japan is expected to conduct its monetary stimulus policy as it used to do in the past months. The necessary condition which has to be present for the dollar-yen currency pair to test 115 and to get above this level is the calm geopolitical picture, because if we get an increase in tensions, then the market players will once again increase the demand for the Japanese yen as a safe haven refuge currency. If that doesn't happen, then the pair will be able to continue its way to the upside, and the pullbacks to the downside will be opportunities to join this bullish market. At the same time, not all news from the United States are positive. We have spoken about the bullish driver for the US dollar, which is the expectations of the Fed's rate hike in June. But this week there were news from Donald Trump, and it seems that as long as Donald Trump is US president, there will be sudden shocking market news, and Donald Trump looks like a constant source of the market's risk aversion. So this time he fired FBI Director James Comey, and this was a really strange event, as Comey was fired and he was at the conference speaking when he saw on the monitors the news that he was fired. So this was a really strange and surprising step. But this step created fears of political turmoil in the United States, which may derail US stimulus and tax reform. We already know that it is quite difficult for President Trump to push through his bills through the Congress. He managed finally to pull the healthcare bill through the House of Representatives, and now faces some battle in the Senate. But now this new controversial issue with the US lawmakers may slow down the process of Trump's reforms and his tax reform in particular. And in addition, there is a risk that there will be an investigation of Trump's connections with Russia, and this may actually be a very explosive topic, and it may create this source of political instability and this source of risk aversion, which can provide a setback for dollar-yen currency pair. So for now, let's have a look at the 4-hour chart as well. For now, we see that there are many positive developments in dollar-yen currency pair, and levels around 113.25, 113 will be attractive for short-term bullish positions in the US dollar. I would like to recommend conservative targets near 115 mark. For that purpose, deeper declines will lead to correction to 111.30 area, and only a break of 115 level will be a signal that we are up to some stronger bullish movement of dollar yen, and it is kind of risky to count on this scenario at this point, with the US Federal Reserve's rate hike already being priced in the US dollar rate. So and these risks present, I think that a safer bet is to fix profit around 115, and this is likely what the market players will do with this pair, despite the fact that we had this beautiful break to the upside here in dollar yen. And in the remaining minutes, let's have a quick talk about commodity currencies, because they experience some interesting moves. Today, the main topic of the market was the movements of the New Zealand dollar. Here it made a very, very impressive and volatile move, testing levels as low as 0.6817. The Reserve Bank of New Zealand kept its monetary policy unchanged. It stuck to the neutral policy bias. But the main shocking element for the market was that the central bank approved lower rates of New Zealand's dollar, and actually said that the market may have misunderstood the central bank and its policy. So here we had a clear signal from the Reserve Bank of New Zealand that it doesn't think that the country's outlook is good and favors lower rates of the national currency. So we can see that resistance located at 0.6950 is extremely strong, and it seems very very unlikely that the currency will manage to overcome this level despite some improvement in commodity prices. On the weekly chart, we can see that the price action is going on around the 100-week moving average, which is located at 0.6882. And this is also an important reference level. Let's mark it here. Currently, this is a level of resistance, and also pay attention to the minimums of December 2016. The minimum is located at 0.6860. So we can even lower our resistance to 6860 mark. Weekly close below this resistance, the lower this close would be, the more likely you will see significant declines in the New Zealand currency in the following weeks. So if we have broad picture, then we will need to be aware of levels around 0.67 as potential targets in case of the close below 0.6860. If we have a more short-term picture, then attempts to recover will meet resistance around 0.6860, 0.69, and 0.6950. Just for the sake of interest, let's add the weekly pivot point indicator to this time frame. And actually, you can see that the indicator levels here will get rid of everything. We don't need to. The indicator levels for New Zealand dollar tell us that there is actually potential for a decline to lower levels. So the pair is currently only on the first weekly support, and the second and the third weekly supports are still available on the downside. So this is the picture for New Zealand's dollar. Also, we can see that Canadian dollar has significantly declined in the recent days. The US dollar has gained versus Canadian dollar, and despite the fact that we saw the recovery in oil prices, Canadian dollar failed to recover as much. The thing is that Moody's agency downgraded Canadian banks, and this affected the currency. For now, it seems that we have a consolidation, and we have a triangle here on the chart of the US dollar Canadian dollar. We'll wait for comments of the Federal Reserve speakers and the US data due tomorrow. These data releases will likely make the pair move outside of this triangle. On the weekly chart, we can see that the US dollar has managed to regain important levels to overcome resistance located at 0.3590, and even we can put here 0.36. And as long as the pair is trading above this level, we can expect a attempts to get higher, although we are currently at the top of the channel. So I think that further movement to the upside in the US dollar, Canadian dollar won't be able to sustain such high momentum as we already saw, and the near-term sessions, the pair should be limited by the area of 1.38. Support, on the other hand, is located at 1.36 and 1.3530. So currently some movement to the downside may take place, but we'll be looking for some buying interest at these levels of support. So now I think it's time to make a conclusion, as you probably need to prepare yourself for trading on the Bank of England's meeting, which will be in 10 minutes from now. So my short conclusion is the following. The US dollar is currently in a bullish stage. We saw that there was a kind of reversal in the US dollar index from the strong support level. And the main bullish driver for American currency is represented by the expectations of the Federal Reserve's rate hike. However, this factor is already largely priced in, so further advance of the US dollar will likely be much slower. If we look at the Bank of England, probably the most interesting event in the short-term period, there are expectations that the central bank will leave rates unchanged, but what the markets will have to watch is the comments of the Governor Carney and the minutes of the meeting. If two members of the MPC vote for a rate hike, and if Carney is concerned with high inflation, then British pound should be able to break levels around 1.30. This is, however, less likely scenario. The majority of the analysts think that Carney will still sound hawkish because of the Brexit and the upcoming UK election, and that British pound will correct to the lower levels of support. As for the single currency, it has some technically bearish factors in the near term, but fundamental picture is rather well. So we will watch for levels of support at 108.25. Below these levels, we will target 107.40, but around 107, we'll consider buying the single currency. And Japanese yen has weakened versus the US dollar, but currently we expect some setback to the downside in dollar yen to 113.25. Our upside target lies around 115, and for now we don't see strong bullish drivers in the US dollar to clear this level. Commodity currencies have weakened despite the rebound in oil prices, especially New Zealand's dollar has suffered and may even extend its decline to much lower levels. This is what I wanted to tell you today. I thank you for your attention, and I wish you good luck in your trades, whether you are planning to trade on the Bank of England's meeting or not. So thank you for your attention, and see you next time. Goodbye.